Hello everybody, my name's Ian McLelland. I head the energy and resources businesses at Edison. Today we're joined by a guest and a colleague to look in detail at the European renewables market. It's a very opportune time to be having this conversation because there's a lot of market uncertainty and you'll be reading about it a lot in the press. Accompanying this interview is a number of other interviews that we've done with some of the companies that we deal with across the renewable sector, and you will find those videos along with this on our website. But for the purposes of the conversation today, I have here, actually physically in the room, James Smith. James is the fund manager of the Premier Miton Global Renewables Trust. I'm also joined here with my colleague James Magness, who works with me. He heads our energy research business, and James is going to sort of talk through the report that he wrote and then talk about some more developments that have happened since that report was published. So first of all, James, can you please introduce yourself, introduce the report, and take it away?
Thanks. I'm a director in the energy and resources team at Edison with a particular focus on building out the clean energy franchise. Overall, I've spent 22 years in finance and investment, mostly in equity research, both buy side and sell side. I've been covering the clean energy space since 2005, when the wind and solar industries were both emerging as viable future technology choices. So I've broad and deep experience across many companies and industries that are subject to energy transition and decarbonisation. At Edison, we're here, of course, to support companies getting their message into the market and maximise investor outreach. The Renewables report that we published end of May considers the accelerated energy security proposals in the EU and UK, which were made in response to unprecedentedly high wholesale energy prices. We analysed the impact of the new proposals on renewables and estimate that they could account for 70% of EU and UK's combined electricity production in 2030, up from around 40% today. This implies double-digit growth rates for new wind and solar installations over decades and equates to a capital requirement of into the trillions of dollars. We believe that the renewable developers will be significant beneficiaries and that value will also ripple to other areas of the value chain, such as the equipment manufacturers and component producers. Since the publication of our report in May, there have been further inflationary pressures on raw materials and equipment prices, along with an increase in the cost of financing, and this is impacting margins. In addition, both the UK and the EU are currently exploring electricity market reforms, which include the decoupling of different power generation sources and potentially capped prices for renewables.
Okay, thanks, James. And James Smith, please introduce yourself and the world of the Premier Miton Global Renewables Trust.
So my name's James Smith. I'm the manager of the Premier Miton Global Renewables Trust. I think we can refer to it as PMGR for ease. And I've been running that since 2012. I have about 25 years investment experience, covering areas such as infrastructure, utilities, and for the past few years specialising in renewable energy.
And if I can just ask the question, because we're talking about the trust, does the trust invest across the whole of the value chain associated with renewables?
It doesn't. It invests globally, so it's a wide remit in that sense. But what we try and look for are energy generation companies, so renewable infrastructure. Not solely that, so we own related infrastructure areas such as electricity networks or energy storage assets, but primarily what we're looking for are physical assets producing long-term revenue streams. So we'd own a wind farm, but we wouldn't invest in Vestas wind turbines, for instance.
All right, okay, that's a good point. So maybe James Magness, if we just turn to you here, because obviously for people who don't know the renewables market very well, it is quite a complicated value chain. So maybe if you can just you lay it out in your report, but maybe just briefly introduce it here.
Yeah, sure. So the renewable space comprises a number of different industries. On the developer side, there are utilities, independent power producers, infrastructure funds, and other energy-related companies that are investing in renewables. These companies have a mix of models ranging from greenfield development for their own use to brownfield development and sale of assets. Developers purchase equipment from the renewable equipment providers, and for wind, this tends to be from European and North American companies due to the complexity of the equipment. Solar, on the other hand, is more commoditized, and so low-cost East Asian producers are often favored. Many components are involved with renewable equipment, including power electronics, and there are therefore many companies on the component side of the chain. There are also numerous service companies that provide a collection of operation and maintenance services, for example. And also in the report, we consider grids and infrastructure companies, as these are critical to the widespread penetration of renewables. So short and long duration energy storage is crucial as renewables penetrate the energy mix. Lithium-ion batteries are the dominant solution for short duration, and gravity storage and hydrogen are important for longer duration.
Okay, so we've kind of laid out the sector. Let's be honest about it. There's really only one thing that everyone's looking at right now, and that is the impact of high commodity prices and the positive impact that is having on renewable energy companies, but then consequently what reforms or interventions there may be from the market regulators and governments to redistribute those profits. So I'm going to be turning to James Smith soon, but maybe James Magness, if you can just give, because some people don't really understand why, when we're talking about renewable energy, why should it be affected at all by commodity prices, and therefore why is it under the spotlight? So could you maybe just give a brief description of how the market is structured and why this is therefore such an important thing?
Yeah, sure. I mean, just taking a step back, the energy security packages discussed in the report are extensions to pre-existing regulation aimed at decarbonising the power generation sector, along with energy-intensive sectors. And the EU provides high-level emission reduction targets for member states, and it's down to the member states to devise their own national energy plans to meet the targets. And there's often we're seeing a disconnect between some of the country plans and what is required of them to meet these emission reduction targets. And what we've got at the moment is, on top of that, there's a discussion of potential EU market reform, which would decouple the different power generation sources from one another, such that the renewables, for example, may have a capped price received for the electricity generated by renewables, which right now they would receive a much higher price at the marginal generation source, which is currently gas. So that's where the discussion lies, and I think it's clear that the EU needs to think carefully about this cap, because you don't want to stifle that investment that's been coming into the space and in fact needs to accelerate in order to meet these high-level emission reduction targets.
Yeah, I think that's a really good point, and I'd maybe just invite the viewers of this also to watch some of the company videos. One of them in particular, Miton, the CFO who was interviewed, and that lays out an argument very, very, very well, just as you're alluding to there, James. And then I guess, so that was the EU perspective. From a UK perspective, there's an awful lot of focus on this just now. And so I'm going to turn to James Smith. I know that many of the fund managers who are investing into the renewable space are trying to explain where this the issues that are going on and how there's a lot of uncertainty. So maybe if you could take us through your thoughts about the market reforms.
Yeah, it's all come up rather suddenly. I mean, throughout the back end of 2021, we saw gas prices going up, and I can show you a chart of the UK gas price, wholesale price, and the UK wholesale electricity price, and they are pretty much the same line. So this has been happening for a while, and it's caused by a bit of a shortage, really, in global gas supplies. So increased demand in Asia, opening up post-COVID, etc. So we've seen increasing electricity prices. Now, of course, the government are quite keen to make sure that people can afford their electricity and their gas bills, and they can see that the renewable energy producers are taking a higher revenue stream with no consequent increase on their costs, therefore their returns are going up. So as James said, that gives everyone a dilemma. On the one hand, investors can't be presented with these asymmetric risks where if power prices go up, it's taken away from them. But if power prices go down, that's something that they have to bear, because that would be a very difficult situation. So I think both the UK government and the EU are looking for an acceptable compromise that everyone might be happy with. Now, the EU have come up with a proposal to have a maximum electricity price that can be taken by the renewable sector of £180 per megawatt hour. Now, we don't need to worry about what that means too much, but it's roughly twice what the electricity price might have been a couple of years ago, or maybe slightly more even, but less than half of what it is now. So that kind of sounds like it's roughly the right area. Now, those same negotiations are also happening in the UK, but we don't have any clarity sat here as of right now what that number will be. So we've seen a lot of weakness in the UK renewable energy company shares because, of course, markets really, this is a risk that we can't price at the moment. So I'm afraid I wish I had something more concrete to tell you and give you an opinion on a particular figure, but unfortunately there isn't a figure out there at the moment. So we're all waiting to see what happens.
And in your opinion, is it likely to be a price cap rather than, say, a windfall tax, which is how they try to tackle the oil and gas sector?
I think in the UK, they'll personally, I think if they were sensible, they would try and follow the EU, because this is a global market and particularly a European-wide market. So the companies that are investing in the UK, they could quite easily switch that investment into Germany or France or Spain or whatever it is. And in fact, I own a number of companies that have investments all over Europe, including the UK. So it was quite difficult, I think, for the UK to adopt an entirely different pricing and regulatory approach to Europe, because you just see a leakage of capital.
So coming back to the asymmetric risk, there's a bigger issue here, which is really, ultimately we're trying to accelerate the transition towards renewable energy as fast as possible to meet climate targets. That's probably more important than anything else. Do you believe, James, that with now these uncertainties that are coming into the market, could this really significantly derail the growth expectations of the sector?
I suppose it could do in the short term, but we're going into a period now. Well, we're coming out of a period over the last 20 years. Our electricity usage has fallen every year, roughly about 1.5% to 2%, because we've become more efficient. Now, over the next 20 years, that's very likely to go into reverse. So instead of using gas for heating, we'll use more heat pumps. People will drive more electric cars rather than fossil fuel cars. So the chances are that electricity demand will start to increase. So if the government puts in place, let's say, an energy price cap or a windfall tax or however they choose to do, and we see levels of investment falling away, then the balance between demand and supply will just get ever tighter until something breaks. So at some point or other, we have to acknowledge that the only game in town for satisfying electricity demand is new renewable energy. And if we look at the energy that's currently on stream, we've got gas, we've got renewables, and if we look at everything else like nuclear, that will be a net reduction over the next 10 years. We've got a couple of new nuclear power stations coming on stream, but far more will close. And coal, again, is dropping away. So the only power source we can actually increase our use of over certainly the next 5 to 10 years is renewable energy. And if we don't incentivize its build, if we don't put in place the right framework, we'll see an ever greater shortage of energy, which will just exacerbate the problems we currently have. So I think there's a danger here that we end up putting on a sticking plaster to cover short-term symptoms, but we end up making the underlying problem worse. And that's something that the government really has to tackle and make sure they come up with an acceptable compromise that not only remunerates renewable investment, but also keeps power prices at a reasonable level.
And to add to that, I mean, once that compromise that solution's found, we need to see countries, the UK and member states in the EU, removing red tape in renewable consenting to help accelerate the transition and encourage investment. At the moment, some of the consenting processes are far too lengthy in some countries.
Yeah, I think that's a fair point, but I think it would also be equally fair to say that the technical execution of renewable projects is generally far easier and far shorter than any of the competing technologies, and again, that is a reason why that is the area where we will be seeing most of the growth.
Yeah, I'd also like to add on the support side. I mean, we've talked about policy, but the EU, there is at EU level, there's significant funding support in the form of the Resilience and Recovery Facility, which can provide up to around 750 billion euros in grants and low-cost loans. So that's an important source of support for companies investing in renewables and other decarbonisation projects in the EU.
James Smith, any thoughts around funding issues?
Banks have been very willing to fund the sector, as have equity investors. And of course, at the moment, we're faced with increasing interest rates, increased uncertainty for equity returns, and those things will push up prices. I still think that within current electricity markets, there's more than enough headroom there for underlying costs to go up and returns still to be more than acceptable for renewable energy generators.
Okay, well, thank you both. I think we've covered in quite a lot of detail the thorny issue of reforms. Maybe if we just sort of step back a little bit, because we are trying to give a wider view about the opportunities and how people should think about investing into renewables across Europe. I mean, I guess one thing to think about here is the geographical differences. Europe big. So maybe if James Smith, why don't you take us through how you think of the market, Northern Europe, Southern Europe, and what is likely to develop in each of these sort of areas?
Yeah. I suppose the odd thing is that although we've had Brexit, Europe, as in the continent as a whole, not as the EU, is becoming increasingly integrated as an energy market. So if we look at the UK, for example, 20 years ago, it was an island, not only in geographical terms, but also in electricity terms. But now, of course, we have power cables. We have 2 into France, into the Netherlands, into Belgium, 1 into Northern Ireland, 1 into Southern Ireland. We're about to, so 1 to Norway has just been commissioned, and they're building 1 to Denmark, which will be the longest in the world. And what that means is that power markets, for instance, are increasingly correlated. So we have to, when we're making investments, have to think entirely EU-wide. And this comes back to my point earlier that whatever the UK government does, it has to also do it by reference to what's going on in Europe, because it is more interconnected. And the UK has certain natural advantages in wind, for example. So North Sea offshore is probably the best place in Europe to do offshore wind because it's fairly windy, and B, the seas are fairly shallow, so that cuts down the costs. So in future, we may see that there is a North Sea wind may be interconnected into continental Europe, not just the UK. So a wind farm on one day may be selling its power to the UK market, on the next, the following day it may be selling its power into the Dutch market. So we have to think about all those sort of things. And then if we look at Southern Europe, places like Spain, of course, have a very natural advantage on things like solar. So a solar farm in Spain may produce twice the power, give or take, as an equivalent one in the UK, and not cost any more to build. So of course the returns are better, and it makes more sense. And then we come on thinking longer term to technologies such as hydrogen production, which would work particularly well with Spain, in Spain with solar. So the solar would generate electricity, which you put through an electrolyzer to electrolyze water to produce hydrogen. So we could see Spain becoming an important hydrogen hub, exporting that hydrogen to the rest of Europe, and the UK becoming an important electricity hub, exporting electricity again to the rest of Europe. Now, returns and growth, as James mentioned earlier, have been very good across the entire continent. So, in investment terms, I'm spread all over it, although I have quite large exposures to the UK. But I think it all looks attractive. The growth is strong, returns are good. And, just this very conversation we're having, 10 years ago, would have been talking about renewables being subsidised and needing government help. And now we're talking about, well, they're so much cheaper than every other form of generation, they're making too much money. Therefore, we need to put a tax on them. Well, that kind of tells you all you need to know about the way the market has gone. Fossil fuels are increasingly uncompetitive, costly, irrespective of the environmental aspect. And renewables are increasingly better value, more efficient, and of course are seeing the lion's share of growth in our energy market as a result, and that's perfectly natural.
James Magness, is there anything you wanted to add around sort of geographical considerations? I know you've looked in quite some detail at certain countries and as James was talking about, there's some different approaches are required. So anything that you can think of?
Yeah, just to add to that, I guess as you've just alluded to, I've looked at some markets in detail, in particular Greece, where McLelland, one of the companies that we have interviews on, have a significant domestic exposure. Now Greece is, again, like Spain, a very, very favourable market for solar. And if you look back at the recent market auctions in Greece, solar has been the dominant technology choice, and winning bids have been as low as the 40s euros per megawatt hour. And this compares to wholesale electricity prices well into the hundreds of euros per megawatt hour at the moment. So it's just incredible how low cost some of these technology choices can be in the right market with the right natural resources. I'd also add that there's countries that are further behind others in Europe in terms of decarbonisation. For example, Poland, which currently has, it's still currently heavily dependent on coal for its power generation. Now, if it's to meet the target set upon it by the EU from a carbon emissions reduction perspective, it's going to need to start legislating towards and encouraging heavy investment in renewables in the coming years. I mean, again, with Poland, if you look at their current transition plan, in my view, it relies too heavily on gas. So we will need to see change at the country level in terms of thinking and strategy on renewables, and perhaps some of these countries might be interesting future markets to look at.
I'd just add one thing, just coming back to our geographical discussion, there's a really interesting situation going on at the moment in France, which not all of your viewers may be aware of. Now, France is predominantly, their electricity market is a nuclear market, which accounts for around 2/3 to 3/4 of their total electricity generation. Now, the average age of a French nuclear reactor is, I think, it's around 37 years old. So it's it's coming up to its, well, in fact, past its original design life. And if we look at the production from those nuclear assets, it's fallen quite sharply over the past few years. And that means that we're talking about interconnectors and the issue of being connected between the UK and the continental European grid. And that means that your power prices are increasingly correlated. So historically, the UK has always been an importer of power. Now, over the last 6 months, we've suddenly turned into quite a large exporter of power, predominantly to France. So that's something that's really affecting the UK electricity market. And given the length of time it takes to build a new nuclear power station, I think France really has to gear up strongly for new renewable development. So I think France is a particularly important area, not only for France, but also for the UK.
Yeah, no, that's really interesting. So I guess, trying to sort of get towards the end now of our conversation, what does this actually mean for the investor? So, James, crystal ball time, you're running your fund. What's your thoughts about how to balance a portfolio to maximise the opportunity?
Well, I think one good thing about the sector is there are different sorts of companies that produce different sorts of return. So by putting them together, you can generate quite a nice blend of growth and income. So on the one hand, we have like the UK renewable energy funds, which are more about income than growth. So their business model is to buy either pre-construction or newly built renewable energy assets and then run them for their operational life and pay out most of the cash flows as a dividend. And if they wish to acquire more assets, they would tend to raise more equity. So that's an income type investment. On the other hand, you have companies that just do pure development, by which I mean they go through that long, difficult process that James alluded to earlier of designing the project, getting the planning permission, getting the environmental permissions, and that all takes time. And then you have a project which some of them may keep if they're an integrated company, others they may simply sell to the renewable energy investors. And those kind of investments are more growth oriented, probably slightly higher risk, slightly higher return. But by putting them together, you can get a blend of a good income together with participation in the sector's growth.
Okay. And how's the fund done?
Well, that's a good question. Up until August, if I'd gone back over the previous few years, it's been a really good ride. It's done really well, very strong returns. Since August, of course, we've had a sudden spike up in yields. And we've had all the particular issues regarding uncertainty in the UK over the legislation to do with renewable energy. So like the market, it has fallen quite sharply over the past 6 weeks or so. However, I'm not sitting here thinking, it's the end of the world. If I look at the underlying assets, they're still every bit as profitable as they were. Dividends will continue to increase. And I think we have to remember that a lot of the problems we're seeing now are as a result of high inflation. Now, many of the companies that I invest in and that James looks at have very strong inflation linkages, either through some sort of government support or tariff, or through a corporate sales price. So if interest rates are high, and they stay high long term, it's probably because inflation is high and is staying high long term. So those two things should offset each other. And I'm hoping that over time, the benefits of that inflation linkage will be increasingly recognised by the market and the share prices will be rewarded.
Okay, gentlemen. Well, thank you very much for all your time today. James Smith, I thought it was some fantastic, interesting insights from an investor perspective. So thank you very much for your time. James Magness, again, very interesting what you had to say, and I encourage the readers to read your report. For myself, I'm just going to wrap up by saying I think that clearly there is a huge opportunity for investors here. We've heard how robust the fundamentals are within the sector. There's some really interesting companies in there. I encourage people to look at the videos of the companies who participated with us in this event. If you want to meet any of those companies, please do let us know. We'll be happy to connect you. And equally, if you're interested in James's trust, I'm sure he'd be very happy with your business. Thank you.